So welcome everybody, and this afternoon we've got four distinguished panelists. The name of the session is Private Equity Trends and Untapped Value Opportunities. I enjoyed watching Nouriel and Mohammed speak this morning, and all the various macroeconomic conflicts. We've seen 2021 with a fantastic year for private equity in terms of exit values, but also a fantastic year for equity markets in general. Let's look at the trends as we face a completely new economic environment going ahead for the rest of 2022. So let me introduce our panel, and I'll start with Patricia Weber at the end there. Welcome, Patricia. So Patricia is CEO of Nevo Capital. She leads advisory to the UK, Nordic, Asian, and Australian markets. She's also CEO of Apollonial, which is a blended finance company based in Luxembourg. Next to Patricia, we have Ali Alaf. Ali is a principal at the Riverside companies in charge of origination. Riverside is a multi-strategy global investment fund. And prior to Riverside, Ali also worked at Ebury Partners in London. It's a global fintech company specializing in international cash management solutions. Next to Ali, we have Sohail Lalani. Sohail is CEO of Eglinton Partners, based in Toronto. It's a global growth and private equity fund. And prior to Eglinton, Sohail spent 12 years in senior private equity positions, most notably with Adia in Abu Dhabi. And he's based in Toronto. And then finally, right next to me, we've got Nitan Pathak. Nitan looks after institutional client relationships at the European Investment Fund, which is part of the EIB based in Luxembourg. And prior to that, he was a corporate finance advisor at Raymond James. So let's just get straight into it, and let me ask the first question. So we've had record exits in 2021. What's your view on that? How is that going to continue in these different markets? And I'm going to start off with Sohail on that one.
Sure. Thank you. So obviously we've all heard about the macro environment that got us here with record low interest rates, especially during COVID, where the government was pumping in a lot of capital, and we had low interest rates even before COVID, right? 2008, 18, 19. So we had this very kind of really good 10-year bull run in the equity markets, private equity markets. Fundraisings were high, and then when you have interest rates so low, private equity obviously becomes a pretty attractive asset class for the large endowments, pension funds that are looking for better than 1% in bonds. Equity markets did well too. So as a result, you had exits, you had good performances, and then you had some of these funds that just continue to raise more and more capital. And the whole macroeconomic environment was very conducive for that. As a result, we had record exits, as you've pointed out. And now we're in this environment where there's definitely been a significant pullback. Interest rates are rising, inflation is high, and so will record exits continue? I think it's going to definitely be pressured. There's a lot of dry powder. I think Dr. Mohammed mentioned earlier, where you've got close to $3 trillion in private equity capital that has been raised, or private asset capital. So that capital needs to find a home, but there's also time for that, right? There's typically on a 5 to 10 year cycle. So I personally think that deal activity will slow down, especially this year. It'll be more cautious, but the asset class itself is still pretty well positioned, in my view.
So Nitan, let me bring you in. So in your opinion, are private equity funds paying too much for assets right now?
So, from our perspective, we are a fund-of-fund investor. So we invest into mid-market private equity funds. And so my answer will be tailored to the feedback that we're getting from fund manager. And we recently did a study on market sentiment from those GPs in the mid-market field, and they would say that the valuations are still increasing over the next 6 to 12 months. So I think the corrections that we see on the public market is not yet correlated to the price of the individual assets.
And why is that?
I think there's a lag, So at the moment, there's also a lot of competition for good assets. Investors are fighting to get, access to the right investment opportunity. And then I think the underlying portfolio companies are still showing a very strong cash flow. So they are financially stable, and there is no reason for them to underprice their valuation.
So Ali, let me bring you in now. So are there any particular sectors you're seeing that are overvalued or even undervalued?
Before that, I'd like to come back to the question
Sure.
whether we pay too much in private equity. And I think we pay too much if you don't get the money back, right? I think that's, there's so many thinkings and ideas around, prices haven't gone up to levels that cannot be sustained. And you think that, and then a few years later, you see record exits from those exact, companies made those exact investments. So I think the question whether or not private equity pays too much, it's difficult to say at the moment. We'll see. But I think there's been a little bit of short-sightedness, and I think we've experienced that already when markets have started opening up again post-COVID, right? We saw some companies that did tremendously well under conditions where people were stuck at home and you would invest in your house and whatever you needed to do. And then, 6 months later, when people could go out and take a beer again, they stopped investing into those companies. So I think that question is always a little bit difficult to say. I think in terms of markets that are doing particularly well at the moment, we are going back to what Sohail said in terms of a new interest rate environment and inflations. We're likely going to have to be a little bit more selective and cautious when we think about the investments that we do in the future again, which means that we're probably going to start talking about resilience again. The way we did in COVID, right? You started talking about resilience. If you could show resilience and growth during difficult times, then you're going to achieve those, premium valuations. And I think that's going to play exactly this time around again.
Sohail, what do you think? Are there particular sectors that are overvalued?
Yeah, so again, obviously if you look around, you saw technology being, having a major push because of the whole stay-at-home trade, right? Whether it was Netflix, whether it was, DoorDash, Uber, all these other companies that were benefiting a lot. And then you saw in the kind of growth economy and the early stage economies, the similar businesses that were benefiting a lot. You had healthcare as well. That again, because of COVID, because of the increased focus on and emphasis on healthcare and what the next pandemic may bring, there's a lot of money that went into that, and so you will always see sectors. And then you had the dining out sectors that were suffering, right? And then you had the normal defensive sectors which were not doing as well because they just weren't providing you with the growth. And that's coming back a little bit now. You're seeing the rotation in the equity markets. You probably see that in private equity too. But again, just valuation generally too. When I was at Adia back in 2008 and 2009, you guys would remember, everyone's old enough here to have invested during that time. We did have a crisis, and the crisis at that time arguably was even worse, right? Because you had a financial banking crisis. Going to Ali's point, the good assets, in private equity, as long as they were well capitalized, so you didn't take over leverage, even if you paid up for them, if they were quality businesses, they grew into their valuations. And what happened was some of the best vintages in terms of returns were right after the crash, right? And then when you look at even the vintages that were during the crash, which was 2008 and 2009, on a relative basis, the performance was still much better than equity markets. So as long as you are with the right managers, from a fund of funds perspective, with the right assets, you haven't over-leveraged your balance sheets, high quality businesses, if you've invested in them, they do catch up to their valuation, even if you have overpaid, because you can't sit on the sidelines and wait for a correction to happen. That's not how investing works, right?
So Patricia, tell me what you're seeing in the markets you cover.
Well, my take on it on my side of markets is I work in different areas. I'm based in London, but I work with, I would think this sort of like the emerging areas, the emerging markets in a different sense. So based in Luxembourg, we rather like the London, really. Most things come through Luxembourg in terms of moving on to other assets, to other quarters. And that's been quite an interesting area because we deal specifically also with the Nordic area, the Nordic regions as well. And that's been a very untapped region with a lot of innovation and a lot of PE going through that area. So the markets there are very stable, they're very cautious. Not much movement there other than what they're doing already, but a very strong equity market in Helsinki, in Copenhagen, in Oslo. All those areas are very strong, very forward-thinking, but very innovative. And across the pond, my pond, is also dealing with the Asian-Australia market, which again is very forward-thinking. It taps into the Asian market and the ASEAN market, and that has seen fast innovation, especially technology. And although it's been hit by COVID quite badly, they too have been very innovative. They've been quick thinking into moving fast and have caught up quite quickly in the PIE area. So it's been quite a mixed bag, but innovation has played a big part in getting people back into the solid area of the market.
So Ali, what's your outlook for private equity? What do you see in the next 6 to 12 months?
I think it's a good question. It's easy to generalize here, and I think we should be careful in doing so, because the situation that we're in at the moment with rising interest rates and stressed. Sorry, I've come off a little bit here. Sohail, do you mind?
Sure. I think, and we were just having this discussion early on too, right? It's with record fundraisings, right? There's a lot of capital out there that needs to find a home. There are still quality companies, but there will be this wait and see approach, right? Where, to your point earlier, Nitan, where there's a bit of a lag in valuations. And also, I think, the senior strategist from BlackRock mentioned it, right? Where in private assets, you are not necessarily sellers, right? So you've got a mark to market in public markets. That's because you're trading pretty actively. But in private markets, you don't need to sell. And so if you don't need to sell and buyers have a different view on valuation, you're going to see lower transactions.
Yeah.
But the fundraisings have already been done. So at some point, something's going to give, and then you will see transactions come back up when you've got some more visibility. So private equity doesn't go away. I mean, we've seen this. Your transactions will go down. The prices will correct a little bit. You will see a lot more structuring come into deals. So the way you leverage the deals, a minority protection, some exit rights, which had gone away because it was so frothy. So I think that will help. People will focus a lot more on diligence because things were happening too fast on deals. So what will come out of this, you'll have better vintages. And so the time where people actually slow down on investing, that's the time you should be increasing your investing in private equity.
Let me be nosy and ask, how healthy is your deal flow over the next six months?
So I'm not going to sit here and say it's not healthy. The deal flow is healthy, but we are taking our time to look at, just like I said, look at the companies that we want to invest in. And there were companies, by the way, that we wanted to invest in, but too expensive, or didn't give us the diligence that we wanted. And some of those companies are coming back, right? And so we're going to take our time and to be able to do the diligence that we think is appropriate for our investors. And whether it's technology, that's been beaten up a lot, and we invest in technology a lot. We still think in a low-growth, stagflation environment, if that's what's going to happen, there's not going to be any other sector that's going to give you the growth that a lot of the investors need. And so while everybody's shunning technology, we actually might look to add on more exposure at reduced prices because of the growth. So the pipeline looks good, but it's going to be a little slow.
Yeah, I think at fund level. So if we are seeing also some kind of the consequences of what the colleagues are describing, which is a lot of new private equity funds. So first-time team, first-time fund at private equity level, so in the mid-market space. And because of COVID, we had tendency to re-up into a fund manager where we had an existing relationship. And so there's been a backlog of looking at new teams, and I think there are some extremely good teams that have come to life with a very specific focus on themes. So they have a thematic focus on climate, on industrialization, on commodity And I think this is representing also a great opportunity in the private equity landscape over the next 6 to 12 months. For us, the pipeline is full, so we can't just see enough of these fund manager, and I guess this will ripple to the rest of the value chain of private equity.
Yeah.
So, Patricia, where are you? Which sectors do you see the most activity in the next 6 to 12 months? Would you say?
I think it's like what other people have said on the panels before. One size doesn't fit all. It depends on what you're looking for, who the companies are, who you are, whether you're PE or whatever. So, I think it's a reasonable question to ask, but it's as long as it's broad. But I think the sectors themselves will dictate themselves, because so much of what's going on or has gone on before COVID or COVID itself has changed the landscape so much as how we now look at things and what opportunities we've got. And I think these gentlemen are right in terms of what they're saying. There are opportunities out there, but whereas before investors might have charged right in and said, right, that looks a good idea, I think people are doing more due diligence. They're taking a more cautious approach into the opportunities, and when they are opportunities, are going in much more well-informed and much more cautious, and obviously hoping we've got better leverage on that. So to say that, I think digital assets, and obviously we've got crypto tomorrow, but there's a lot new things going on in the space, and I think people are taking their time now to have a look at things more closely.
Okay, now let's turn to the pricing of deals. So, central banks are behind the curve. Interest rates are going to rise probably all over the world. How's that going to affect the price of deals in private equity? I'll start with you, Nitan.
So in terms of pricing of the underlying portfolio company, I think, as I said a bit in the earlier answer, in my opinion, what we see from the market is that the prices are being still stabilized. So there's no high fluctuation on the pricing of the underlying companies. Now, with all the macroeconomics, factors affecting the pricing of company are, unforeseeable from that stage. So I can't imagine something happening. But from what we see for the next 6 months, we don't see much fluctuation in terms of pricing of the portfolio companies or fund managers.
That's interesting. Sohail, you're based in Toronto. What do you see in terms of a high interest rate environment? How does that affect you?
Yeah, it's a good question. So I think all else equal, you should see a correction in prices, but the reality is a lot more nuanced than that, of course. I don't think you see a one-to-one offset in pricing, because there's a lot of capital, like I said, that has already been raised, right, that needs to find a home. What I do think, and we're already seeing this, and I expect this to continue to see this, and again, this has happened in prior crashes as well, where the higher quality assets do get some discount, but they still trade to a premium. So the disparity grows. In times when interest rates are really low, mediocre assets are also overpriced. When times are tough or interest rates high, that's where the quality really comes up, right? And they will still command decent prices, whereas a lot of the crap gets underpriced and suffers.
Ali, what's the view from Stockholm?
Yeah, no, I think that's a very good point. I think in terms of the prices, it's difficult to predict, right? Because we just come from a period of distress. COVID happened, Q1 2020 Europe, everything died down. And just a few months later, all of a sudden public equities rose to the high, M&A became more expensive than ever, and also fast, right? Everything went so fast, it was difficult to really follow lead. And then, you're thinking, what happened? A year and a half, about a year ago, we didn't think we had a jobs, and now you have to really pace up. So I'm more optimistic, I think, about this situation, because cost of capital has come up, yes, but on the other hand, the leverage ratios have gone down significantly. When you talk to young people that come out of school, they still think private equity leverage deals 90 to 10. That's ludicrous, If you think of the software, we do a lot of software, for instance, and if you think how we leverage our deals, it's a fraction of the total enterprise value of the money that we need to put up in the end. So I think the cost of capital, for some it's going to increase, for some it's going to maintain. Of course, it will have an impact on money, but it's a little bit of on valuation, but it's a little bit of a conundrum, because at the same time we have the drypowder levels. I don't know what it is, but it's probably plus $1.5 billion US at the moment. So you have a lot of funds with a lot of money, and they cannot go to their LPs to say, look, market's not good at the moment, so we're going to hold back a little bit. That's not how this sort of relationship works. You need to be able to place money in good and bad times, show good returns, and if you're not finding those opportunities, some people are probably going to start paying more than they initially wanted to. Just make sure that they can buy assets and acquire them and build their portfolio, and then you have 5 years to figure out how to create value in those portfolio companies, right? So I think value creation is going to be super important in this coming period.
So Patricia, if valuations do decline, then how do you think that'll change the way private equity firms think about exit strategies?
I'm not sure really how that will change how they think. I think they will, because no one's got a crystal ball, but I think they will look at perhaps the collaboration and perhaps talk to other parts of their organizations and other parts of the company that they might not have talked to before. And I think that's what we're seeing more and more, is that there are other areas, even generational, where, as you've heard from what happened before, senior managers might have thought that their decision-making and the way they've done things has carried weight because of what's gone before, but we're now going forward. And I think there's a lot to be said for the juniors, the young people coming up, whatever term you would call young, but in a different sector, and joining sort of the older way of doing things and see how you can now, rather like we work from home, hybrid our thoughts going forwards. And you're seeing that a lot in terms of two different sectors working together, asset managers and NFTs, or Bitcoin with something else. There's a hybrid way of looking soon. So that's what I'm seeing at the moment in advisory.
Okay.
So, sorry, if I can just add. So if you're referring to exits in particular, I think three ways you'll see probably changes in private equity. One is, because IPOs are going to go away for a little while, right, given the state of the markets, you'll see more M&A activity because equity markets will probably be, they are cheaper. So a lot of big PE funds that have capital that's raised, they're going to now get active to acquire companies, take them private. So you're going to definitely see activity on that side. From a buying perspective. On the exits in particular, you've got secondary funds that have been very active, right? And continuation vehicles, long-term continuation vehicles for private equity funds. So PE funds that have high quality assets, typically they've got a 10 to 12 year fund cycle. They don't want to sell in a down market. They go to the LPs for a vote. Would you like to continue owning the asset for several X years? The reduced fee or whatever the arrangement is to give them incentive. And for high quality companies, especially the institutions that don't need the liquidity, they don't want to exit in a subprime market, right? Which is not ripe for an exit perspective. And then you've got the secondary funds that come in and do the pricing. So those things will still happen, but you're not going to get those huge exits for a while that we've been accustomed to for the past couple of years.
So I can confirm, this is extremely true. As an LP, we don't push for our fund manager to exit company just because they want to raise the next fund, or because they have to meet some kind of payment schedule to meet the target IRR. So we like our fund manager to keep the company in the portfolio and wait for the right time to exit. Now, we have been approached quite a bit over the past 6 months with secondary transactions, so GP-led or LP-led. And there we have taken a proactive role in acquiring stakes into funds where we think that there are value drivers still, and where some of the LPs are looking to exit for other reasons. I think most of the LP that are exiting a bit faster than expected is not because they don't like the strategy. Sometimes it's based on a change in management or change in strategy, where they would like to reduce their allocation to private market for a reason, and to a region, So I think it's very much the situation that, in my opinion, private market as such will continue to grow as an asset class. We are allocating more and more money into it, and I think the exit is not really the issue. Okay, so in the last 6 months, any investor invested heavily in tech equity markets have been solidly or badly burned. What are the big tech themes that are going to drive private equity in the next 6 to 12 months? And which tech themes, artificial intelligence, blockchain, tomorrow we've got fintech, health tech, which tech themes do you think are going to attract the most private equity investment going forward? Sohail?
Yeah, sure. So I think 6 to 12 months is a little short for tech theme discussion right now, just given where we are in the kind of markets and the correction that's happened. But if we were to take a little bit of longer-term view, I think fintech is definitely a strong driver. And that started with COVID, with everybody being at home and really using their phone for more kind of, whether it's digital banking, whether it's buying stocks on your phone, whether it's sending money. So fintech takes all of that into account, and there are companies. We have companies in our portfolio where many of them are innovating at speeds that we have not seen in the past. Some of us in the space talk about this being the kind of e-commerce revolution like 10, 15 years ago, right? So that we think continues to go up. There's health tech. Again, we're going to see a bit of a pause now, but the innovation will continue because there's still a lot more growth there. There's insurance tech, right? Where just insurance companies and industries have been so outdated and done things in such an old-fashioned way that they're just ripe for disruption. And we're seeing a lot of disruption there. There's ed tech, which of course there's been issues in China. Basically any sector you add tech nowadays, and you're seeing disruption in that space. So, but fintech, I would say fintech and health tech is definitely up there.
Patricia, what do you think? What tech themes are you seeing?
I don't know whether I'm seeing them, but I think the sectors that in tech are beginning to join up. So one of the big areas is gaming and AI, and then going into film. That's quite an extraordinary area, and that in itself feeds into or trickles even into defense. So the whole skill set of gaming, and it's worth billions of pounds, and AI is quite an advanced sector, and that has got, that's got quite a big flag to it. The other thing is, I think, is space technology and the satellite industry and what's coming from renewable energy in terms of satellites and monitoring things. And we've seen the impact of the extraordinary technology and use that's been used in weaponry so far, but that has far-reaching implications in terms of even down to how you have land, how land is perceived from satellites, where we plant our food, wheat, grass. The whole implications of that is quite vast. So there's quite a lot going into even agri-technology from satellites, etc. So I see space technology and the whole area of that side of it possibly tying up with AI as possibly another area that's quite good, is what I'm seeing at the moment.
Great. So as a tech analyst, that's music to my ears. So I've got one last question for the panel, and then if you could get ready for your own questions if you'd like to ask this panel anything. And my final question is, this is an AIM summit. We've heard about the 60-40 split equity bonds. What can private equity offer investors today in this uncertain world? Nitan?
Yeah, well, I think first of all is one of the only way to access private market. So I think people have realized that doing it by themselves is quite difficult. Doing it along fund manager or fund of fund manager is something a little bit more easy. I think the other thing is it provides a good way to diversify your portfolio if you are a multi-asset kind of investor. And I think that at the moment, private market is allowing you to balance a little bit the public market or public exposure that you have with respect to equity investments. Then I think people through private market are accessing deals, that are local. So people are going a little bit more, how is it that I kind of invest locally and I make a difference to my community? Private market is allowing you to invest in a small industrial commodity company, which is local in Germany, for example, or others. So I think there are very specificity of private market investment beyond returns that you can get, and our role is really to educate people who would like to get into, because we always talk about increasing the share of private market, but we need to also try to understand why is it that it's not going faster. And I think there is a part of learning how to access the market, and this is a bit the role of institutions like ours in Luxembourg.
Great. Sohail, what's your view?
Yeah, so I would definitely add the diversification point, because again, the point that was made in the BlackRock session earlier is that institutional investors are not forced to sell. And when you're not forced to sell, you don't get those wild swings up and down, right? So that helps in times like this. The other thing is innovation and growth. Like if you look at public companies out there in public markets, normally they're not very big innovators, but especially in times like this where they need to tighten their belts, right, and watch their balance sheet and talk about laying off employees. So if you really want access to innovation and growth, it's still going to happen in private markets. So I think that and a long-term portfolio where the returns, while they may be low for some vintages, the spread relative to equity markets or fixed income is still going to be so meaningful. And with the alignment of interest, I think the last session they talked about fees and stuff. Yes, private equity managers do charge fees, but they're aligned with they only make money when there's an exit and you make good returns, right? So I think that combined is what's still attractive.
Ali, we heard this morning that private equity could be 50% of portfolios. What do you think? What's an appropriate percentage?
I don't know, but I'd like to continue on that question. I think private equity, if anything, can provide stability. Like you said, it's not a liquid asset class. It's lumpy. It's slow-moving. And every single transaction is made thoughtfully by investment professionals and people that have spent months tracking assets, sometimes years, right? I think that stability is unprecedented. And you saw that in public equities. You did really well for a period of time, and then you do poorly very quickly, and there's no way to recover or even react to it. So that stability private equity can offer, I think, is tremendous. And you could see that going back to the great the Great Recession, I suppose is called, the post-Lehman crash. Some of the companies that did absolutely best were the ones that were under ownership of private equities, because they have the time and the money to invest in those assets. They could back them when it was difficult to get lending elsewhere. Since they pool capital, they also have access to different types of cash, but also that intellectual the intellectual capacities that comes with private equities, I don't think should be underestimated. So they could give that extra love that is needed to make sure that an asset is ready to be exited when it's time or rolled into a continuation fund. Either if it's doing very bad or doing very good, and you wanna retain that. So I think private equity is gonna add a lot of stability in uncertain times ahead here now.
And Patricia, you got the final word. What can private equity offer investors?
I'd agree with everybody as well. I think private equity on one side continues to give stability because it's what people knows. But I think also there's the opportunities there, as what the headline has said. It also has the avenue to perhaps step into places where public sector can't go and be much more nimble and faster, and perhaps give those results where ordinarily that wouldn't be able to happen in the wider public remit. So that's what I see.
Fantastic. So let me open it up to the audience. Do we have any questions for our panel? Yeah, this young lady in the front.
Yes, hi, thank you very much. The question is to all the panel, and I just want to ask you, if possible, to see how do you see investing in the Central Asia, which is a part of emerging markets? Because all you said is very relevant, very interesting, but very much applied to the existing markets of Europe, America, but the emerging markets have very different risks on one side, but on the other side, they have a great potential, because the young generation in Central Asia is the growing age sector, and by 2050 is going to be the largest region of the young generation. So taking in consideration what you just said, how do you see particular Central Asia in your investment portfolio? Thank you.
Great question. Who'd like to take it first?
I'll take that.
Yep.
Yeah, that's one of the areas I specialise in, and that's one of the key things I thought today. Obviously we talk on the West, but Central Asia is what you call Central Asia. It's vast. There's so much innovation there. There is a tie-up. There are talks between Central Asia and Europe, but not enough. And the innovation is quite skewed on both sides. But I think both sides have quite a lot to offer in terms of the innovation and the young people, and so much, especially in terms of technology and healthcare. So much, I think, of the Asian culture as well is to do with age and what we can do in terms of the aging process, and so much can be learned both in terms of healthcare, nutrition, technology, wearable technology, and also in terms of the innovation that happens with the young people and how they can move quickly and faster. So I think there's a lot innovation to be done there, and the key parts is to work together and get the message across, really.
I mean, from a European institution perspective, we try to address the private market through co-investment agreements. So we try to to create a facility where we invest each other money in respective market, and we do knowledge sharing with that. So we try to define cross-border element that could help one country and the other, and we try to set up some facilities to deploy. But to be very honest, we don't do enough of it. And in the current environment, people tend to look more into being local than looking at the global implication. So definitely a point to improve from our perspective.
Sohail, Ali, would you agree with that?
I don't have much to add if you want to take another question, but
sure.
I think.
So any more questions? Yep, there's a gentleman up back there.
Hi there. So my question is more focused on the deal-making side of it. Are you guys looking at deals where you have sophisticated family offices coming in, bringing you transactions and saying, look, I want you to participate in it? Or are you guys going to sophisticated family offices? Or are you saying investment bankers bring those deals to you? I mean, we have participated in a couple of sizable transactions last month. And we are seeing that as a trend where you have private equities. They're not the biggest of the biggest, but they're sizable private equities that are coming in and working with sophisticated family offices, whether it's single family office or multiple family office. So that's one question I wanted to know about the trend. And the second thing is on the exit side, are you seeing more of the investor base coming to you and more willing, to say Sohail's point, to roll over an investment that you might have made because the fundamentals are changing, the strategy is changing. So you're seeing that more of an interest from investors to roll over? And what is the feedback if you were to go back to the investors and say, look, we need, the fundamentals are changing, the economy is changing, the markets are changing. So if you want a better exit, this is what we are suggesting.
Sure. So I could start because I deal a lot with family offices, and it's actually a pretty topical question. So family offices over the past, I would say 10, 15 years have become very sophisticated, generally speaking, in private equity and alternative asset classes. They've hired good people, pay them well, they're smart, and they're doing very interesting deals. And so a lot of my LPs, our funds LPs, are actually biggest LPs are family offices. They bring us deals sometimes. We're not waiting for the calls from the investment banks because those are typically deals you don't want to do by the time they reach you. So we are actually proactive with our private equity partners or executives in the sectors or other industry players, and sometimes family offices who we get deal flow through too. And so it works both ways, but it's not where an investment bank comes to us. That's not the type of deals we like to do. On your second point, very quickly, I think it depends on the institution. So most of the longer dated institutions, the pension funds and sovereign wealth funds that don't need liquidity in the few years, and I wouldn't put the family offices in that yet, because the family office still want the flexibility of 5-year exit or 7-year exit. But the bigger institutions, my prior employers, for instance, it was not just a continuation, but it's also this thing about paying a toll fee every time. Because they're high quality assets, and if you're like an ADIA or a Canadian pension fund or Harvard, you've got Carlyle at one side and KKR on the other side, and KKR is selling an asset to the same asset to Carlyle, and you're in both funds, and you have to pay them carry and fees, and then you have to pay them carrying fees, right? So you're like, why do I need to do that? And that's where the funds are also pushing to say, hey, if it's a high quality asset, just continue to accumulate, and I'll just pay you the toll at exit, right? So that's how it started. But now you've got the situation where it's not at the most opportune time to sell the asset, and so you have these discussions, and then of course the pension funds or the bigger, longer dated funds are then taking their pound of flesh, if you will, and saying, all right, let's hold it on longer, but then we want a discount. And so definitely a lot more open to it.
So I think, unfortunately, we've run out of time. My thanks to my panel, Patricia, Sohail, Ali, and Nitan, and I'm Cyrus. Thank you very much.
Thank you.